Now we'll turn to the statement of activities, also known, as I mentioned, the income statement. Again, highlighted in blue is the key equation. Revenue minus expenses equals your net profit, or it looks like your change in net assets, your change in net worth. Again, the terminology will differ, but the concept is the same. It shows how much revenue an organization has earned and what cost it's incurred over a period of time. Unlike a balance sheet, which is presented as of a particular date, the statement of activity is shown for a period of time, generally the fiscal year when you're presenting your external financial statements. Many not-for-profits will have a fiscal year that ends on June 30th. However, it doesn't have to be that particular date. Colleges and universities usually have a June 30 year end because it's a meaningful end date once graduation has taken place, and it's a break within the typical fiscal year activity for the organization. Calendar year companies will have a fiscal year end, or I'd say for-profit entities will have a fiscal year end of December 31st. Many retail organizations typically have their fiscal year in January or maybe February after the big holiday shopping rush. The change in net assets within the statement of activities, it can be positive or negative. Obviously, you'd like to see your revenues exceeding your expenses, and therefore your change in net assets would be positive. And as we mentioned earlier, the statement can be called many different things: the income statement, P&L, statement of changes in net assets. I personally think for us as individuals, it's the statement that we can most easily relate to. Likely we all produce our own budget, and therefore we all produce our own statements of activity. What are our sources of income? Our salaries, our investment income. What are our expenses? Well, we may have rent. We may have other utilities we need to pay. We all prepare our own budgets, and essentially that's our own statement of activities. So here's the statement of activities for the American Sleep Apnea Association. And don't worry too much about the unrestricted or the temporarily restricted columns on this schedule. Let's focus on the total columns for just a minute. Again, it's presented comparably for 2015 and 2014. In 2015, you can see that they had revenue of about $220,000 and expenses of a little bit more than $221,000. So for this particular organization, their changes in net assets are negative. The same was the case for 2014 to a much greater extent. That change in net assets is then reconciled at the bottom of this schedule to show how net assets started the year at $33,000 and how they ended the year at $32,000. And that'll agree back to the balance sheet, which we'll see momentarily. Now let's talk for a minute about how the different captions are presented. Generally within revenues will be presented based upon how meaningful they are to the organization. For sleep apnea, contributions are their most meaningful source of revenue, and therefore they've presented those first. Here at Harvard, for example, it may be student tuition, so tuition revenue will be presented first. For a hospital, it'll likely be patient service revenue. There is no one way in which a set of financial statements needs to be presented, but the key is they need to be presented in a meaningful way to the users of the financial statements. Now, how about expenses? We talked a short while ago about the functional expense statement and how organizations are spending their dollars between program, fundraising, and management and general administration. In this case, the Sleep Apnea Association has shown that breakout right here on the face of the financial statements, but that's not required. They could have shown these expenses in a natural classification. They could have shown salaries, supplies, interest, depreciation, and other similar expenses in that fashion, and then showed the functional expenses in a separate schedule. Again, it's at their option, and they chose to show here in the face of the statements the expenses broken out by function. So let's talk about now the cash flow statement. As I mentioned earlier, the cash flow statement will show the cash flow from three categories: operations, investing, and financing activities. And on the next slide is a fairly simple example of a statement of cash flows. Again, this is going to be, over a period of time, how has cash changed. In the top section, you can see cash flow from operating activities. And this is what accountants and auditors refer to as the indirect method of presenting a cash flow statement. That is, we're reconciling the change in net assets to the cash provided by operating activities. If you remember from our discussion a moment ago, sleep apnea lost $1,399 in net assets during the course of the year because their expenses exceeded their revenues. That is the starting point for the statement of cash flows. And then this is then reconciled to how cash is provided by operating activities. We'll talk in a minute about the differences between cash versus the accrual basis of accounting, but in this case, that change in net assets did not always require the use of cash. When they were complete with this reconciliation, you can see that operating activities in 2015 essentially broke even. They generated $81 of cash. In 2014, however, you can see that the decrease in net assets was fairly significant, close to $30,000. However, the cash inflow provided by operating activities was close to $9,000. That's why this reconciliation of cash flow from operating activities is very important. In a particular year, if an organization is not generating cash from operating activities, they may need to turn to their investing or their financing activities. So let's look at 2015. Sleep apnea essentially broke even. They didn't generate much cash from operating activities. But let's look at what happened within investing. Within investing, they spent about $4,000 to purchase property and equipment. Therefore, the net cash outflow from the year was just over $4,000. Whereas in 2014, we are now generating cash from operations, and we used a little bit of that cash to purchase property and equipment as well. So in 2014, they generated more cash from operations and in total than in 2015. And much like we did on the statement of activities, there's a reconciliation at the bottom that shows how that change in cash ties together with the way cash is presented on the balance sheet both last year and this year. We've touched upon the statement of functional expenses quite a bit so far in this course. It's prepared for certain not-for-profit organizations, but not all. As I mentioned, in the case of sleep apnea, they presented the functional statement right on the face of the statements, in which case they wouldn't need to duplicate that statement elsewhere. The intention here is to show much more in a specific nature how the expenses are incurred for charitable purposes for the program versus other overhead purposes. And it's used by those users of the financial statements to show how efficient the organization is operating. So here's a very detailed statement of functional expenses. And don't get overwhelmed or scared by the level of detail here, but essentially it's a matrix. And so if you look at your total expenses in the bottom right-hand corner of the page, you can see that total expenses are $221,000. That'll tie back to the statement of activities. Down the left-hand side, expenses are presented by their natural classification: salaries and other employee-related expenses, printing, office supplies, travel, and you can see on down the line. And then across the top, they've broken out their expenses by both the program, as well as G&A, general and administration, and fundraising. And if you look at the bottoms of those columns, the program expenses of $171,000, the management and general expenses of $17,000, and the fundraising expenses of $32,000 will all agree back to the statement of activities. In fact, we've spoken quite a bit so far on each of the statements about how each of these statements reconcile. And that's key because all of these statements do integrate and reconcile with one another. So here on this slide, we've shown a brief excerpt of each of the statements. The balance sheet in the middle, now remember that's as of a point in time, so it's a still picture, as opposed to the cash flow statement on the left-hand side of the screen and the statement of activities on the right-hand side of the screen. Now look at what I've highlighted in yellow. Your cash on your balance sheet is going to tie to the bottom of your cash flow statement where we've presented ending cash. And now look at the orange highlight. Your total net assets at the bottom of the balance sheet will tie to the bottom of your statement of activities. Again, all of these statements operate together, and as one item increases, another item will also change by an equal amount. So now let's turn our attention to cash versus accrual accounting. Two very different concepts that we'll spend some time discussing here as well as in Module 2. First, the cash basis recognizes revenue when cash is received and expenses when cash is paid. Think about it as checkbook accounting. When you write a check and send money out the door, that's an expense. When you receive money in the door, that's revenue under the cash basis of accounting. It's used by me to balance my checkbook, it's used by small businesses, and my guess is it's used by many not-for-profit organizations. What are some of the benefits? Well, it's fairly easy, straightforward, and from an auditor perspective, of which I'm one, it's very easy to verify when you've incurred an expense or when you've generated revenue. However, there are some drawbacks, there are some costs. It can misrepresent your financial condition and the activities and the cash flows of an organization, which we'll see shortly in an example. It's important to know that generally accepted accounting principles do not allow the cash basis of accounting. And we'll talk about a compromise that exists within accounting called the modified basis of accrual accounting. So I mentioned on the previous slide that the cash basis of accounting can distort the true picture of your balance sheet and your performance. So let's take a look at an example here, which quite honestly is not too far from the truth. Let's say that I have a new job. I have a salary of $50,000, and with my salary I bought a new car for $20,000. I didn't pay cash for that car, but I used an auto loan. In addition, I'm going to use my credit cards to cover a lot of my other expenses, and let's say for purposes of this example that my other expenses are approximately $25,000 on my credit cards. Quite a bit of money. In addition, I pay my rent. My rent is about $20,000 for the year. So look at the left-hand side. Under the cash basis of accounting, we have cash of $30,000. I brought $50,000 in revenue in my salary, and I paid $20,000 in expenses for rent. So therefore my balance sheet will show the net cash of $30 and no liabilities. Under the cash basis of accounting, I don't have any liabilities. On the income statement, I have my salary for $50, my rent that I paid for $20, my net income for $30, and so that net income will then reconcile to the balance sheet and show my net worth of $30,000. But that's not really the true picture, because if we shift to the accrual basis on the right-hand side of the screen, I still have my $30,000 in cash, but I also have another asset. I have a car. I bought a car, and I have the right to use that for a period of time. And that car, when I bought it, was worth $20,000. So under the accrual basis of accounting, that should be recognized as an asset. So you can see when you move from cash to accrual basis, your assets have gone from $30,000 to $50,000. Now what about those liabilities? Under the cash basis of accounting, I didn't have any liabilities. But it's very clear that the lending organization who lent me the money to buy a car, as well as my credit card companies, are not going to forgive that debt. And so that's an obligation I have to other parties. So I need to recognize both the liability for my credit card debt for $25,000, as well as my car loan for $20,000. So now I have, under the accrual basis of accounting, total liabilities of $45,000. Let's shift down to the income statement. Well, I still have my salary for $50,000, and I still pay my rent for $20,000, but remember all those other credit card expenses I have for $25,000. So now the excess of my revenue over my expenses is not $30,000, it's only $5,000. And therefore my net worth is not quite as high as I realized it was under the cash basis of accounting. A very simple example, but you can see how if you expand this to a not-for-profit organization that has many other transactions occurring throughout the year, the differences that can be created when you move from cash to accrual basis. And that's why, as I mentioned, GAAP does not allow the cash basis of accounting for external financial reporting. So under the accrual basis of accounting, I mentioned it's required, The key there, as you saw in that example, is that cash can be received before or after revenue and expense is recorded. That's the key. The timing of cash receipt does not always represent when you've earned money and does not always represent when you've incurred the expense. The benefits here is that it really reflects your true financial performance and your financial position, irrespective of what's paid or what you've received in cash. Clearly the cost, as you could guess, it's much more difficult and costly to maintain, and it can rely heavily on estimations and judgments as you determine those liabilities that you have to other parties. So I mentioned there's a compromise. That compromise is the modified accrual basis of accounting. We'll talk about the modified accrual basis in just a moment. But first, let's talk about revenue recognition under the accrual basis of accounting. Under accrual accounting, revenue is recognized when two criteria have been met. That is, revenue needs to be earned and it needs to be measurable. When we say earned, that is the event or the process of earning has taken place. You've provided a service, you've provided a good, your ownership has been transferred. These are critical events that determine when you recognize your revenue. What are some examples? Membership dues. If you're collecting your membership dues in January for the month of January and you provide that service to your members in the month of January, well, you've earned your revenue. But if your members are paying their membership dues in January for the month of February, you haven't earned that revenue until you provide that service to them in February. As such, that cash that comes in the door would not be recognized in January. It would be recorded as a liability, deferred revenue, and you would not recognize it through the statement of activities until the following month. Another example is deferred tuition. Oftentimes, colleges and universities will collect tuition payments right up front at the beginning of the semester. However, they don't earn that until they provide that service to students over the course of the semester. And then we talked about measurable. This goes back to the monetary concept we talked about at the start of the course. It needs to be reasonably assured and can be measured with a fair degree of reliability in a currency. That is, there needs to be a net realizable value that you can determine. What about expenses? Under accrual accounting, expenses are recognized when they've been incurred and they're measurable. What are some examples of expenses? Well, it could be the salaries that you owe your employees. When your employees provide a service to you in the month of January, you've incurred an expense that you owe them salary for. Maybe you don't pay them that salary until the first week of February, but you have an expense in January because that employee has provided you a service. Or perhaps you've purchased some goods or you've ordered some food for a cafeteria. When you've received that service or you've received those goods, generally you've incurred an expense. And we say at the bottom of the screen here, the matching principle is key. Generally speaking, expenses are recognized when revenue is recognized. Expenses are recognized as revenue is earned. So let's talk about an example. Again, going back to our membership dues. If you receive your dues in January for the month of February, you have an asset because you've received cash in January and you record that asset, but you'll also record a liability, deferred revenue. Revenue is not going to be recognized until the month of February when you've earned that revenue and provided the service to those members. And when your expenses are incurred, again, your employees are providing service to you in February, you'll incur those expenses to match the revenue. So we talked about a compromise. The compromise is the modified accrual basis of accounting. We mentioned that the accrual basis of accounting can be costly and difficult to maintain throughout the year. So this compromise that many not-for-profit organizations use is that they maintain their internal books and records on the cash basis of accounting throughout the year, and then perhaps on a monthly basis or on a quarterly basis, but definitely on an annual basis when they present external financial statements, they'll convert the cash basis to an accrual basis, to the accrual basis of accounting. Sometimes they use external accountants for these accrual adjustments, but it is a compromise that still allows you to meet generally accepted accounting principles and be more efficient in how you maintain your books and records. The challenge, however, and I caution you, is that if you use the cash basis of accounting throughout the year, just be careful you're not putting too much emphasis on those cash basis set of financial statements and ignoring potential obligations that you may have or expenses that you've incurred that have not yet been recognized. It's never good to be surprised at the end of a quarter or at the end of the year when you make that conversion from cash to accrual and you recognize that your net worth is not quite as high as you thought it was.